Live from KUSI, this is Good Business San Diego. Sponsored by Wilsey Asset Management.
Hi, I'm Roy Robertson. Welcome to Good Business San Diego, where we're talking about the topics that are important to you, your home, your family, your health, and your money. And the following portion of Good Business San Diego is sponsored by Wilsey Asset Management. Now, as an investor, are stock dividends or stock buybacks more beneficial to you in the long term? Chase Wilsey, Vice President of Wilsey Asset Management, is here to break it down for you. Chase.
Thanks, Roy. And it's a great question. A lot of times people look at investing, they're like, gosh, do I go after companies paying stock dividends? I hear about stock buybacks. Are they good? Well, unfortunately, the truth of the matter is there's no hard and fast rule when it relates to what is better. But I got to tell you, I definitely lean towards stock dividends. Reason being, it is something essentially the company can't take back from you. They pay out that dividend. Now that's yours to do with it as you please. Stock buybacks, on the other hand, they are beneficial too. Don't get me wrong. We've had a lot of companies long term that have done stock buybacks, and we've done very well in those investments. Now you pair stock buybacks with dividends, now that's a great recipe for success. But the reason stock buybacks can be so beneficial, well, what it does is it increases your ownership in that business. You're now getting more of the sales, more of the earnings, more of the book value, more of the cash flow of that business. That is why stock buybacks can be great. But as I said, the dividends, you look long term, a big reason those are successful. Many times companies' earnings, they increase in the long term. So they increase that dividend. Now what that means, all of a sudden you could have an investment you bought 10 years ago. The initial dividend yield was around 3%. Now it could be around 10, 13, maybe 15%, depending on how much they increase that dividend. So that is one of the secrets to why dividend investing can be so great for the long term. One reason you got to watch out for dividends, though, is they can get cut. You got to make sure a company has good cash flow. They don't have a high payout ratio where they're taking too much of their earnings or too much of that free cash flow to pay out that dividend. Those are keys you want to make sure you understand. Dividends as well, they do come with a tax-favored status. So what that means, you pay maybe 0, 15, maybe 20% on the federal side, depending on your tax bracket, rather than ordinary income tax. That is one thing that I will say stock buybacks carry a benefit on. There's no taxes on that capital distribution from the company. But stock buybacks, one thing you do have to watch out for is companies that could announce a stock buyback. Let's say they're like, we're going to buy back $10 billion worth of stock. That sounds great, but they don't have to fully oblige by that. They might not fully satisfy it at the end of the day, so you've got to keep an eye on that. Also too, stock buybacks, a company, well, they could buy back a ton of stock, let's say at $100 a share, but then 2 years later, maybe it's at 80. Well, that would have been a complete waste of capital, and you definitely would have preferred the dividend at that point in time. One other thing when you're looking at stock buybacks, sometimes you have to understand that a $5 billion buyback might be more beneficial than a $10 billion buyback. What I mean by that, if a company has a $1 trillion market cap and they're buying back $10 billion worth of stock, well, that's only 1% of the shares outstanding. But if a company has a $50 billion market cap and they're buying back $5 billion worth of stock, well, that's a 10% buyback. That is going to be far more beneficial than the company that was doing the $10 billion buyback with a larger market cap. So these are all numbers that you do want to make sure you understand when you are looking at these capital returns companies announce. One thing I will point out at this point in time, it is hard to find good yielding stocks. Things have definitely gotten very expensive when you look at the S&P 500. Right now, the yield's about 1.2%. And unfortunately, this is near the lowest that we have seen since the tech boom and the subsequent bust. And I gotta say, this could be another warning sign that maybe the S&P 500, the overall stock market, may be too expensive. If you like this content, make sure you go to our website, smartinvesting2000.com. A lot of great podcasts, newsletters there to make you a smarter investor. Thanks, Roy.
Thanks, Chase. Appreciate it. The preceding portion of Good Business San Diego, sponsored by Wilsey Asset Management. We'll be right back.